So you want to learn how to pick the next Nvidia or Apple, but to get them really early. I mean, who doesn't? Stick around and I'll share with you my 7 favorite picks going forward of stocks that might turn into a 10-bagger or 20-bagger. But first, let's talk about how you even get a 20-bagger. How do you get to a point where a stock is worth 20x the original investment or even more? I've been doing this for 25 years and I have many 10-baggers in my portfolio. The biggest one I have, of course, is Nvidia, which I got into in 2016 at $15.67. But I also bought Apple at $15 in 2013. I bought Block, which was then called Square, when it IPO'd at $11. And I even bought IDEX Labs at $125. All of these stocks are up significantly higher than where I bought them. But there's a strategy to how you do this in order to be able to get these kinds of gains. Many investors, particularly new investors, will focus more on the idea of getting a 10-bagger rather than picking a winner. Now, what does that mean? It means that if you focus too much on the gains, you might not be able to stick with a stock through its darkest days and miss the opportunity. When Meta, then called Facebook, first came public, it launched around $42 a share and crashed all the way down to under 17. There were a lot of people who thought it was dead money, that it wasn't going to be a good investment, and they bailed. Is now worth nearly $500 a share. That's way more than a 10-bagger, particularly if you were adding on the way down. For a more recent example, let's look at Coinbase, which came public right around $400 and crashed all the way down to under 32. If you'd gotten scared out of it and didn't add to it on its way down, you may have taken a loss, and now it's worth more than $250. Now, this doesn't mean every stock is always going to bounce and go higher. You always have to keep risk management in mind. The most important thing you can do is to make sure you're never risking more money than you can afford to lose on any investment. You have to assume that any company, no matter how long they've been around, could go bankrupt and you could lose everything. This is why it's so important not to go all in on a single investment. You're not going to get rich off of one investment. The idea is to get rich off of many successful investments. Sure, you'll have some stinkers along the way that won't work. We all do. But if you have a well-diversified portfolio, then you'll be just fine. Next up, even if you have a winner, it's important that you have to take profits along the way. Now, taking profits doesn't mean you sell your entire position. It just means that you trim a little when you have lots of gains. I mentioned that I bought Square for $11.10 in 2016, and it hit an all-time high of $289.23 in 2021. However, Block crashed with the rest of the market, and in 2023, it hit a low of $38.85. Now, sure, that's still more than a triple than where I originally bought my position, but that would have been a devastating loss if I had ridden it all the way up and all the way down. Instead, by the time 2018 hit, I had already removed all the original investing capital from the position. By its 2021 high, Block was the biggest position in my investments in play portfolio at that time. But I had removed all of the capital plus 4 times the original capital. In other words, if Block had crashed all the way to zero, if it had zeroed out the equity entirely, I would still have quintupled my original investment in the stock. And this is why I always say it's so important to take profits along the way. So what's going to be the next Nvidia or Apple? All right, spoiler alert, I can't tell you that. No one can. And there are plenty of scammers out there that'll try and charge you for their picks, but no one really knows what the next big hit's going to be. I bought Nvidia for $15.67 in 2016. But I had no idea it was going to be an AI company. I'm a gamer, I always have been, and I've used Nvidia's gaming cards since the late 1990s. I really liked the product, and there was the narrative about them entering the data center and GPUs being stronger than CPUs, so I thought there was a good investment there. Did I have any idea that it was going to rally more than 5,500% from where I bought it? Of course not. I would have bought more. So what can I tell you? I can tell you my newest stock picks. However, my past performance doesn't foretell any future results. In other words, any of these could end up going into the crapper and zeroing out. Out of these 7, I'm going to go in chronological order of when I initially bought them. First up, we have Dutch Bros, which could very easily be the next SBUX. I initially started my position on September 20th of 2021 at $42.25, and now my current cost base basis is $33.15 because I buy in stages and sell in stages. Following that, we've got Roblox, which could actually be the next Meta. I opened my position on September 29th of 2021 at $77 even. And my current cost basis is $42.15. This one has been incredibly volatile. Next up, Rivian could be the next Tesla. Now, a lot of people are anti-Rivian right now. With EVs just getting less and less popular for the moment, it feels like it could be a long way before EVs become commonplace. Everyone who wanted an EV seems to have already bought one. So Tesla and Rivian have both sold off, Rivian particularly bad. That being said, I still believe in the company. I made my first purchase on November 12th of 2021 at $127 a share. Keep in mind, Rivian just hit an all-time low right above $10. However, because I buy in stages all the way down, my current cost basis is $25.06. Granted, that's more than 2.5 times higher than here. But that's still possible. We've seen these kind of movements before. Next up, SoFi could be the next block. SoFi Technologies is a fintech company, just like Square was in 2011, and I think there's a lot of promise there. I initially opened my position on November 22nd of 2022 at $4.80, and thanks to buying and selling in stages, I've taken quite a few profits in SoFi. My current cost basis is $3.80. Next up, we've got Snowflake, which could be the next Salesforce. Snowflake provides AI services in a pay-as-you-go model to enterprise, and it's been incredibly popular. However, it's also extremely expensive in terms of its valuation and has recently sold off significantly when the CEO announced he'd be retiring. My first buy in Snowflake was on February 12th of this year at $231, and my current per share cost is $206.90 because I've been buying it into the sell-off. Next up, Shopify could be the next Amazon. This company provides an e-commerce platform for businesses of all sizes and has been hugely popular, but it's sold off significantly from its all-time highs. I initially opened my position in Shopify on February 12th of 2024 with a buy at $91, and my current cost basis is $87.90. Finally, we have Palo Alto Networks. Cybersecurity has never been more important, and this is one of the leaders in the space. Palo Alto's CEO recently announced that they were going to be rejiggering how they were offering services, and they were going to create a full-fledged platform, which would require them to make an investment in it. As a result, investors who were focused more on growth and profits didn't like hearing this, and sold off Palo Alto Networks significantly. My initial purchase was on February 22nd of 2024 at $270. And that's where my cost basis currently is. I'm going to wait until it sells off more to add to the position. You need to remember that these could all be huge leaders in the space going forward, or they could all go to zero. That's what makes markets. Accordingly, here are a few of my investing rules. Number 1, buy in stages. Never buy all at once. When a stock sells off a little bit, continue adding small amounts to your position. If the stock never sells off from where you buy it, that's just a high quality problem. You can always make the decision to buy at higher levels, or you can do what I do and just say what I've got is what I've got. Number 2, you need to take profits when you have them. If you don't take profits when you have them, the market will take them from you. I take very small profits along the way, but my goal is to get all of my original investing capital out so that I can play with the house's money. Number 3, you have to have a long time horizon. And by a long time horizon, I mean the minimum amount of time I think about any investment is 5 years. And for the vast majority of my investments, my time horizon is more than 20 years. So when I buy a stock, I'm not thinking about where it'll be in 1 year. I'm thinking about where it'll be in 2 decades. Finally, never blindly copy others. Listen to everyone. Learn from everyone, but you must find your own path when it comes to investing. Investing and trading are uniquely creative. You won't have the same risk appetite, the same discipline, or the same strategies as any other investor. You will be a unique snowflake, and over your journey in the markets, you will learn more about yourself than you ever realized was possible. Check out some of my other content here, where I give lots of lessons about investing and do analysis on individual positions.